So now that we've given you a bit of a broad overview of private debt, why would you want to hold it in a portfolio? So to us, the first reason for investing is typically always attractive risk-adjusted returns. So we're finding that it's quite possible in portfolios to generate stronger returns in private debt than we've seen in traditional lending products such as bonds. The returns are often in the form of stable and regular interest payments, which is always nice for us, especially when we're in retirement. Returns in some cases are even commensurate with equities, although that typically will come with a higher level of risk. Secondly, we like to earn returns that are different to the returns we're currently seeing from other investments we hold in our portfolios. And private debt brings that diversification. These investments, while they're not necessarily risk-free, the risk is there, but it's different, tend to act in a very different way to traditional asset classes such as equities or even property. That means that when you add them to your portfolio, they actually work to lower the overall risk in the portfolio due to the diversification benefit. You're also able to get exposure to different market sectors, geographies, which further increases the portfolio diversification. The third reason we see is the strong capital preservation qualities built into private debt transactions. This is tied back to our first point of risk-adjusted returns is very much is very much the strong ability to secure the loan portfolios against collateral such as property, equipment, or receivables. Depending on the LVRs, the loan-to-value ratios of this collateral, that should help to protect capital in the case of a loan default. The inclusion of covenants, which we talked about in the last webinar, also provides extra layers of protections. The other reason is the protection against inflation, which has certainly been topical over the last 12, 18 months. In an environment where you have rising inflation, the ability to structure a portfolio in floating rate loans protects against inflation. So as the central bank increases cash rates, the yields delivered on floating rate loans increases. Even when you're holding private debt that is in the form of fixed rate loans, because you can actually hold them either as floating or fixed, depending on what you're investing into, what you'll find is that they tend to roll into new loans on average over about a 12-month period. So the new loans that you're entering into tend to reset at a higher level. And then finally, private debt will sometimes also present unique opportunities. Given that these loans are conducted in private markets and they tend to be less efficient than public markets, this will normally allow our managers or lenders to take advantage of risk mispricing. So onto a little bit of the educational side, and we won't spend too much time talking on this, but I thought it would be quite good to talk to you a little bit about the due diligence that our underlying investments or portfolio managers do in terms of looking at the loans that they are brought. So they typically will run origination teams, which will bring them loans to have a look at. And it's quite important to understand their due diligence and how they go about assessing these loans, whether they should be funding them or not. So the objective of a due diligence from their perspective is to evaluate the creditworthiness of a borrower, and that will ensure that the private lending deals are structured with minimal risk and optimal returns, hopefully. Due diligence in private lending is the investigative process used by lenders to assess the borrower's financial condition, their operational capability, the industry environment, and the creditworthiness of the borrower before they will be extended a loan.